Imagine waking up one morning to discover that the money in your bank account still has numbers attached to it, still appears to be yours, still buys things, yet somehow feels different, as if someone somewhere has quietly changed what those numbers actually mean. Most people assume money is a neutral tool, a simple medium of exchange tied to value, productivity, and the hard work of ordinary people. But what if that assumption is wrong, or at least incomplete? What if money has a hidden second purpose that has slowly grown stronger over centuries, shaping governments, empires, and institutions, not as a store of value but as an instrument of control? To understand how we got here, we need to travel back to the early origins of money, long before digital ledgers or central banks, back when value was tangible because it had to be. Ancient societies used commodities, grain, livestock, metals, not because they trusted institutions, but because they trusted the physical world. But even then, something subtle was happening. Whoever controlled the measurement systems, the weights, the mints, and the temples often controlled the economy. The earliest kings and priest administrators didn't just facilitate trade. They oversaw it, taxed it, and, crucially, recorded it. The earliest surviving financial documents weren't receipts but instruments of authority. And yet, this shift was slow, almost invisible, until the rise of coinage centralized power further. When rulers stamped their faces into metal, they weren't just guaranteeing weight and purity, they were embedding political legitimacy into every transaction. Value and governance began to merge, but this was only the beginning. Fast forward to the medieval period, and we see another turn. Banking families like the Medici discovered that lending, simply moving numbers across books, held more leverage than gold ever could. Coinage was heavy, limited, and risky, but credit? Credit was infinite as long as people believed in it. The cause and effect cycle accelerated. States financed wars through borrowing. Borrowing required taxation. Taxation justified state expansion, and expansion demanded even more sophisticated financial tools. Money, once anchored in physical scarcity, grew more abstract, and abstraction opened the door to manipulation. The real breaking point arrived centuries later with the global adoption of central banking. Originally designed to stabilize economies, central banks soon discovered they could influence not just prices but behavior. When the United States abandoned the gold standard in 1971, it wasn't merely a financial adjustment, it was a total philosophical transformation. Money no longer represented stored labor or finite metals, it represented government decree. Value shifted from what something is to what someone in authority says it is. From that moment, money became a managed environment rather than an independent reality, and the people managing it gained unprecedented influence. But decisions like these don't happen without fallout. The explosion of fiat systems made inflation a permanent feature rather than a temporary mistake. Wealth concentrated not because people worked differently but because proximity to the money creation process became the new metric of power. Institutions learned that by adjusting interest rates, buying assets, or tightening liquidity, they could indirectly guide entire populations. What people buy, where they invest, how they behave, even how they vote. And when the cracks appeared, crashes in 1987, 2000, 2008, each attempted fix created unintended consequences. Stimulus saved markets but inflated asset bubbles. Bailouts prevented collapse but rewarded reckless behavior. Every solution treated symptoms while strengthening the underlying mechanism that blurred money's purpose. Instead of resetting the system, the world doubled down on it. And now, as the digital era advances, we are witnessing a new phase where the story takes an even sharper turn. Cashless payments, programmable currencies, real-time behavioral analytics, and digital identity frameworks create possibilities that go far beyond the dreams of ancient kings or early bankers. If money is information, whoever writes the code controls the economy, and, by extension, the people within it. Modern parallels are hard to ignore. Data showing that over 90% of all global money exists only as digital entries, or that a handful of central banks influence more economic activity than all private businesses in several countries combined, or that during recent crises entire industries survived or died based solely on which sectors policymakers chose to support. These statistics aren't just numbers. They show a repeating pattern, a feedback loop stretching across centuries. When money becomes less about value and more about management, societies become more dependent on the few who make financial decisions. And dependence always shifts the balance, from markets to authorities, from individuals to institutions, from freedom to oversight. Yet the story isn't purely dystopian. Understanding it gives us power because hidden systems lose their influence once they are seen clearly. So what are the key takeaways from this long arc of history? First, money has never been neutral. It has always served whoever had the tools to define and distribute it. Second, technological transitions, whether coinage, credit, fiat, or digital systems, always shift power upward before society adjusts. And third, the next transformation, whatever form it takes, will likely amplify the same dynamics unless people demand transparency and structural accountability. The warning is simple. If money as purpose drifts too far from value and too deeply into control, we risk turning financial systems into behavioral systems. But the open question, the one only viewers can answer, is whether the next chapter will be written passively or deliberately. If you found this exploration revealing, if it challenged assumptions or opened new lines of curiosity, consider subscribing, sharing this video, and joining the discussion in the comments. Because understanding how money changed gives us the chance to change what money becomes next.